Hi, everybody. Welcome to our webinar, Why You Need a Retirement Income Strategy. We're going to be going over a couple of things you need to know about retirement income. And with me today, I have Eric Stiles.
Hello, everyone. My name is Eric Stiles. I'm a certified financial planner. I specialize in retirement income solutions for my clients.
Awesome. Thank you, Eric. We're going to have a bunch of questions going over everything today. So I'm really excited to have you with us to go over retirement income.
Yeah, no, of course. Uh, so we'll start out. This is obviously it's a very detailed slide, but basically at the crux, and in a station you can start clicking through, you can see that the markets go up and down. Up 106, down 149, up 101, down 57. Then we had so over that time we had the lost decade. Technically that full decade, technically money was not made. And then as we move on, we went into the longest, bull market in history. And you see it wasn't as sharply up as the other ups, but it was a more consistent long-term trend. And then now today we're kind of back to towards that volatility. I kind of we're showing this. We don't have to overthink this slide too much. I'm showing this just to show the markets over the long term trend to go upwards, but they are volatile, they are unpredictable, and it's hard to tell when the next drop is going to happen.
So, knowing that the markets are moving up and down, can you explain to us why a strategy like this might be necessary?
Of course, of course. And as we move into the next slide, we're gonna show you that. So when you're getting ready for retirement, one of the things is, okay, well, how much of my assets do I need to withdraw every year to achieve my living expenses? A general rule of thumb is usually 4% of your assets is what you should take out, because that'd be enough to, for your return to hopefully make up what's taken out, plus also hopefully to keep up in inflation. So what this chart is showing you is when a normal market situation happens in the year you retire, and let's say you're in a moderate portfolio. And if you start taking out 4% in the year you retire, the markets are normal that year. It's not a down market. You're generally only going to run out of money 8% of the time, and so that's a 92% success rate. That's very strong. That's something to feel good about. And as you see, as you move up the chart, 5%, 6%, 7%, obviously that chance of failure over a 30-year period gets higher and higher and higher. And so even just jumping up from 4 to 5, you're doubling your chance of failure of running out of money over a 30-year period. And then as we go on to the next part of this chart, you can see, well, what if the markets don't do well and they're not normal in my first year of retirement? What if the markets go down 25%? That is classified as a bear market. That is normal, has happened many times in the past. It will happen again in the future. But the thing is, we don't know exactly when. No one really knows exactly when that's going to happen. And so looking back to that 4% area, where originally said 8% failure rate, well, if the markets go down 25% in your first year, your failure rate is now at a 22% probability of running out of money over a 30-year period. And we use a 30-year period because a lot of times with people retiring and with modern medicine and longevity, we have to plan for a 30-year retirement period. That's something that needs to be planned for. So now with if year one of the markets go down 25%, that's looking at 1 out of my 5 of my clients are going to be out of money, when a 30-year period's over, if they retired in that year with a 4% withdrawal in a standard moderate portfolio. For me personally, that's concerning. I wouldn't want to have 1 out of 5 of my clients out of money at the end of a 30-year period, which is a standard retirement. And so as we move on through the next slide, we're going to kind of talk more about why this is happening. And so this is happening because when you save for retirement, every paycheck, whether it be biweekly or once a month, every paycheck, a portion of your money is taken out and is put in your 401k. So at that time, you're buying more in your investments, your 401k when the market's doing well. You're buying it more when markets aren't doing well. So that means you're buying when prices are expensive, but you're also buying over the long term prices when they're cheap and you can get most bang for your buck. But so, and when you're saving, when you're investing for long term, you're looking to grow, the thing you're trying to avoid is, buying at a high in the market when the markets are doing well. You're buying when it's expensive. Now, obviously when you're investing, each paycheck, that's going to happen. But the thing is, you have time to make up ground and still grow those assets and still grow over the long term. Like going back to that first slide with the look at the stock market has its ups and downs, but generally over the long term, it has trended upward. And so you can still make money even though you may be buying it at the most expensive time in the market. But on the flip side, when now you're going from save for retirement to spending in retirement, it's gonna differ if we can move to the next part. You're looking at instead of now putting money away and investing periodically, you are selling your investments periodically to fund your monthly distributions. And so that means you are going to sell your investments when the markets are doing well. You're going to sell your investments when the markets are doing poorly, and all the different options in between. It's just your monthly paycheck to cover your living expenses is needed, so it can't be dictated based on how the markets are. So you're going to be selling through all different types of markets. So, but the big difference here is when you're selling, obviously you want to sell it when the markets are high versus contrary to when you're putting money away. But the negative when you're selling is you generally want to avoid selling when the markets are low. But if you need that money and in your retirement, you need the money for your monthly expenses, you're going to be selling when markets are at lows. But the big thing that we need to consider is that when you sell when the markets are low, you are locking in those losses. It's not like the opposite side when you're saving money and you buy when the markets are expensive. You have time to make up and still make money on that. You're when you're selling when the markets are low to fund your living expenses, you're not going to get a refund once the markets recover. That's locked in. That loss is locked in. And that's why that first year and first couple years of retirement is so important, is that because when you first retire, if the markets are having a bear market down 20 plus percent, 25% in the example we used, if that happens, you are locking in those losses in the first year, which really hurts your longevity. So that's why we see that big difference in success rate in that previous chart, going from if it's a normal market to if it's a negative bear market.
And we're not sharing this to scare you, we're sharing this to educate you. And we have something available to a lot of our clients that you might not know about yet to help match your income needs moving forward into retirement.
Of course. And so what this is, we call it advanced time segmentation. It is a retirement income strategy that is built to try to mitigate that risk that we were just speaking of, to mitigate selling stocks when the markets are down. And so what essentially we do, it's a bucketed strategy where we segment your money into three buckets. First one being income, second one being future income, third being long-term growth. In the income bucket, that is going to provide a majority of your income initially in retirement. And it's coming from either super safe fixed income assets that shouldn't fluctuate too much with the markets. So that helps to reduce some of the risk of retiring and first year retirement being a bear market, is because we wouldn't be selling stocks in that bucket. We'd be selling fixed income, which is not going to fluctuate as much generally as the stock market will. And then also in the income bucket, we sometimes use contractual guarantees from annuities for lifetime income that can help cover that income need as well. Future income, what that is preparing to refill the income bucket at some point future in your retirement strategy. So we do get a little bit more aggressive in that bucket, getting ready for that time. Once the income bucket depletes, which it's going to intentionally deplete, we then refill it with the future income bucket. And then the final one, long-term growth, this is where the majority of your stocks will be held. We are going to keep that invested for a long time, untouched, and it can go through the normal ups and downs of the market, knowing that, this is going to be kept untouched for a long time. So by separating across these three segments, we believe that we are going to put ourselves in a more suitable situation to pursue a successful retirement income strategy.
So knowing we use those three buckets, we also break it down into three main categories. But Eric, I think you went over a lot of these already.
Yes, so we have three time segments that we use: income now, income later, and long-term growth. And we fill these segments with across five categories. So look at the first two buckets right there. First two buckets are lifetime income and fixed income. This is filling in the income now bucket. We fill it with a combination of lifetime income that is contractually guaranteed by the annuity company to pay out over a lifetime. And then we used fixed income, which is that safe investment that we're intentionally going to spend down. It's primarily nearly 100% or at least 90% in fixed income. And it's supposed to generate some interest, but it's more about capital preservation and not fluctuating with the markets too much. That third bucket you see right there called balanced, this is our income later bucket. This is where we are going to intentionally save for a target to refill the fixed income bucket down the road in your retirement income plan once that fixed income bucket has been depleted. Now, we will get a little bit more aggressive than fixed income in the balance bucket, but we're still going to be really conscious of risk. So we're not going to be as aggressive as that fourth bucket. That fourth bucket, so then long-term growth, we actually fill with those last two categories: long-term growth and income and growth. Long-term growth, this is stocks. This is stocks. We're going to invest for a long time, intentionally not trying to touch it for a long time, letting it grow uninterrupted. And then the last category that's part of the long-term growth time segment is called income and growth. This is another name for this, we call is durable income. This is a bucket that intentionally we intend to keep open for the entirety of your retirement income strategy. It is filled with dividend paying companies. It is filled with alternative investments. It is filled with derivative type investments and options. Investments that should be a little bit different than your traditional stocks, bonds, and cash to give you a little bit diversification, not just on the investment side, but also on the income side, as far as from a diverse income source. This will provide some income, not as much as the first two categories, but this is what we call durable income.
So just another way of looking at it, if the buckets weren't quite your speed, we do have a chart version as well.
Yeah, so what this chart is showing, this is a hypothetical. If John and Jane, both 60 years old, are planning to both retire at 62, they're putting away 24,000, they're maxing 24,000 a year, increase with inflation. You can see in year one, year two, there's a positive 24,000 and then 24,600. That is them putting money away in those last 2 years leading up to retirement and putting it into the long-term growth segment, growing for the long term. Then if we look at year three, when they're both 62, they retired, no more employment income. Now it's time to live off your assets. And you can see in the second column, lifetime income, we're planning for, in this hypothetical example, 20,000 to be generated from this bucket. And then the bucket to the right, we have fixed income. We have 25,000 planned to be generated from this bucket. And we look to the column to the right in the balanced column, you see that in those first 9 years, nothing is happening there because we're intending to keep that invested and keep it focused on a point in time where we're going to refill the fixed income bucket. And you see in that transition from values after 9 years into values after transfers, you see that we're going to be transferring a healthy portion, 278,000, into the fixed income bucket to refill. So there's that refilling. We're refilling that bucket. And then we look at the long-term growth column. You see, except for those first 2 years when we're adding money to it, we are not touching it for those 17 years. We're not being touched. It's going to grow untouched. It can handle the normal market fluctuations out there. It's not going to be touched. And you see where it's going to project to grow to 1.5. This is all projected. It's based on a estimated annual return. Obviously, nothing is guaranteed, but it's a projection. And then finally, you see in 3B, this is our durable income section. We're filling it with income and growth. We're filling it with alternative. It is going to provide income. But what's different then from this compared to segment 1B is that we're not intending to deplete it. It's not intentionally going to be depleted. The intention is it's supposed to grow while also keeping of giving you some income. But you see, obviously, the income amounts are less than that of 1B. So putting it all together, if you look at the column all the way on the right, you see how much income this strategy is going to produce. Now, granted, this doesn't factor in Social Security, doesn't factor in pension, doesn't factor in rental income. This is just income being produced from your investment assets. Now, this is obviously a sample. Every single person's strategy is different. It has a different setup, different things we're looking for. But this is a custom strategy. This is not cookie cutter. Every single strategy is custom made for you and in your situation in particular.
So I know we went over a lot today from why you need a strategy and one possible strategy for you to use. And if you have any general questions, there is a Q&A box on your screen below, and you can always send it to us. But we also really encourage you to set up a meeting with your advisor to go over this specific strategy and how it might work for your unique situation. Like Eric just said, everything is custom built, and we want to make sure that it fits your specific needs.
Yeah, no, definitely. And then just one last thing to add is that, you know, this plan, what it really does, it tells you exactly year by year where we intend to take your money to fund your income in retirement. It's very written out and it's very clear intentionally because we want to know, hey, 5 years from now we're intending to fund your income from this bucket, this account, and so that we can plan for everything. But I think it's a really good strategy, something I feel confident in. And I think every client should at least give a chance to see what it looked like for them.
Awesome. Well, I don't see any questions in the Q&A box right now, so I think we are good to wrap up. As always, if you have any questions, please reach out to the team. We're available all of the time to answer you and make sure that you're getting the best information for your specific needs.
All right, perfect. Thank you everyone for joining, and have a great rest of your day.